Yeah, welcome back to class. Now we are taking computation of VAT liability. Computation of VAT liability, including the treatment of opening and closing inventory. Computation of VAT liability, including the treatment of opening and then closing inventories. Effective February 1st, 2020, in computing value added tax liability, the VAT output is first determined. The VAT output is first determined. The VAT output is first determined by applying what? By applying the VAT rate at 7.5% on the total sales, net of allowable sales adjustments. Net of allowable sales adjustment. Then thereafter, VAT is determined by applying VAT rates of 7.5% on purchases net of allowable purchases adjustments. So what are the example of allowable sales adjustment? For instance, now if you have discount received, okay, or discounts allowed, okay, so to your customer probably you are giving discounts, okay, so you have discount allowed. So the discount allowed should be adjusted for on the total sales, and you compute your total sales net of the discount. So if your total sale is say 1,000 naira, you're giving discount of 100 naira, so the amount you'll be computing your output VAT on will be 900 naira. So you'll be doing 0.5% of 900 naira. Do you understand? So in computing VAT liability, the VAT output is first determined by applying VAT rate of 7.5% on the total sales net of allowable sales adjustments, and thereafter VAT input is also determined by applying the VAT rate of 7.5% on purchases net of discount received or any other type of allowable purchases adjustments. Allowable purchases adjustments such as discount received, probably we have return outward, okay. So VAT liability for the period is then the VAT output. The VAT liability for the period is the VAT output less the VAT input. VAT output less the VAT input. Are we together? So however, the VAT liability for the current period can further be adjusted if there are VAT reverse charges already deducted by third parties. If there are VAT reverse charges already deducted by third parties, for instance, oil and gas companies, governmental agencies such as MDAs, the ministries, departments and agencies, among others, during the same period, okay. So if you have a VAT reverse, then you need to adjust for the VAT reverse before applying the applicable VAT rates on the net sales, okay. So also a further adjustments may be made if there was a VAT credit, okay. So that is if there is the excess of input VAT, if there is an excess of input VAT over output VAT, so in a previous period. So after you have determined your VAT, the net VAT output, okay, So you can adjust for VAT reverse and also adjust for excess VAT input in the previous period, excess VAT input in the previous period. So the net VAT after these adjustments may either result in a VAT credit, or VAT payable, So a VAT credit is a result of what you have a VAT credit when your input VAT is higher than the output VAT. When your input VAT is higher than the output VAT, you have a VAT credit. But where your output VAT is higher than the input VAT, then you have VAT payable. Are we together? So nonetheless, if VAT liability computation includes inventories, if VAT liabilities computation includes the inventory such as stocks of items or stocks of materials, then there will be need to further adjust the input VAT. So to do this, the period purchases is first adjusted by adding cost of opening inventory. So you determine your cost of sales. Okay, so what you are doing is just like the determination of cost of sales. Are we together? So, and to achieve this, what do? You have your opening inventory. Okay, so let's say 100, and you have your purchases for the period. Let's say 1, 2. Okay, so you have 1003, which is your cost of goods available for sale. Thereafter, the cost of inventory will be what? The closing inventory will be deducted. So then you less or deduct your closing inventories. So let's assume your closing inventories is 200. So the cost of sales in this case will be what? Will be 1,100. Okay, your cost of sales will be what? Will be 1,100. Okay, so it is this net result that you can then apply your VAT rate of 7.5%. Okay, so you apply your VAT rate of 7.5% on these 1,100 So you should be having something like 82.5 naira as your input VAT. Are we together? So it is important to know that inventories are measured at the lower of cost and their net realizable value. The cost of inventories shall comprise all cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and conditions. This is in line with the requirement of IAS 2 under the International Accounting Standard. Okay, so for better understanding, let's see if we can do at least one illustration. Let's practice an illustration. Okay, let's practice an illustration. You are writing Starry Gold Nigeria Limited. Was incorporated some years ago and commenced business in February 2019. So the company is engaged in the importation and sale of chemical products, and the chief accountant of the company resigned in February 2020. So, and in a chance meeting with the managing director. He intimated you that management of the company would want to ascertain the VAT remittable to the relevant tax authority based on the following financial transactions, which took place in March 2018, which took place in March 2020 rather, which took place in March 2020. Okay, so we have the total value of taxable supplies. Total value of taxable supplies. We have 10 million naira. Total value of taxable supplies, we have 10 million naira. We have value of exempted items. Value of exempted or zero rated supplies. Value of zero rated supplies, we have 5 million naira. Then we have VAT on domestic supplies, VAT on domestic supplies or purchases for which invoicing requirements have been met. We have 100,000 naira. We have VAT on imports. We have VAT on imports. We have 200,000 naira. Then we have VAT on purchases. VAT on purchases not wholly used in making vatable supplies. Not wholly used in making vatable supplies. So we have that to be 50,000 naira. Then we have VAT on equipment. We have VAT on equipment. We have 100,000 naira. We have VAT on professional fees. VAT on professional fees paid during the month. We have 50,000 naira. Then we have bank charges VAT inclusive. Bank charges VAT inclusive. We have 100,000 naira. So all the goods were received and sold during the month. We are required to compute the VAT remittable to the relevant tax authority in March 2020. So don't forget that your valid tax rate as of March 2020 is 7.5%. Okay, so the name of the company is Starry. So now we are preparing our suggested solution. So Starry Nigeria Limited. So we have a schedule of VAT remittance. A schedule of VAT remittance to the Federal Inland Revenue Service in July 2018. In July 2018, and we have this. So we have a value of taxable supplies. Value of taxable supplies, including exempted and zero rated supplies. Total value of taxable supplies, including exempted and zero rated supplies, is 10 million naira. Is 10 million naira. We have 10 million naira. So we have to deduct. Okay, deduct or less the value of exempted or zero rated supplies, which is 5 million naira. So we have 5 million naira. So these are total supplies. These are total supplies subject to VAT. Total supplies subject to value added tax. Okay, so VAT received on supplies. VAT received on supplies. Okay, so VAT received on supplies will now be what? Will be 7.5% all over 107.5 multiplied by 5 million naira. Multiplied by 5 million naira. So what do we have? Kindly punch your calculator and confirm the figure to me. So we have 7.5 divided by 107.5 multiplied by 5 million naira. Multiplied by 5 million naira. So we have 348,837. Then you have VAT on domestic supplies. VAT on domestic supplies. So how much is our VAT on domestic supplies? Our VAT on domestic supplies is 100,000 naira. 100,000 naira. So we have VAT on imports. VAT on imports. Our VAT on imports is how much? VAT on imports is 200,000 naira. Okay, so this gives us a total of 300,000 naira. And then we have VAT on purchases not wholly used in making vatable supplies, less VAT on purchases, less VAT on purchases not wholly used in making vatable supplies. So what's our VAT on purchases not wholly used in making vatable supplies? We have 50,000 naira. We have 50,000 naira. So we have a net of 250,000 to be deducted from VAT on taxable supplies. So that gives us what? That gives us our VAT remittance, or VAT remittable, or VAT payable of VAT payable of so let's deduct 348 minus 250,000. So that gives us 98 837. 98,837. So that's our VAT remittable or payable at the end of the month. Okay, so the value tax Act as amended allows input tax as a deduction from output tax to be limited to the tax on goods purchased or imported directly for the sale and goods which form the inventory in the in trade, that is stock in trade. Remember your stock in trade. Okay, so stock in trade used for direct production of any product on which output tax is charged. VAT paid on any overhead, service and general administration of business outfits which otherwise can be expensed through the statement of profit or loss shall not be allowed as input tax. So VAT paid on any capital item and asset shall be capitalized along with the cost of acquisition and shall not be allowed as input tax. Shall not be allowed as input tax. Okay, so let's go on break. When we come back, we shall continue with the other part of this same topic.